Britain's housing ladder isn't just hard to climb, it's missing rungs. Prices stretched far beyond wages, rates resetting and rents spiking are loading the fuse right now. Families who fixed at 2% are staring at 6% renewals. Landlords are exiting, builders are slowing, buyers are pausing. Behind glossy listings sits a market running on borrowed time, where every month of high financing squeezes demand tighter. If a shock hits, job losses, policy shifts, or another inflation flare, the pressure could flip to forced sales fast. Before the headlines catch up, let's open the map and walk the hidden fault lines beneath your street. Number 1. Unsustainable house prices. For years, the UK has lived inside a property illusion, one built on endless optimism and easy credit. The average home now costs more than 8 times the typical salary, making it nearly impossible for young families to step onto the ladder. Property once symbolized stability and progress, but it has become a symbol of exclusion. This imbalance didn't appear overnight. It was the result of decades of price inflation driven by speculation, cheap borrowing, and government incentives that kept demand burning while supply stood still. The result is a market inflated far beyond the reach of real incomes. Every cycle needs air to breathe, yet the housing market is suffocating under its own weight. Demand has cooled, buyers are waiting, and sellers cling to unrealistic valuations. The emotional belief that prices never fall is being tested by harsh reality. Mortgage approvals have fallen sharply, and price reductions are now visible in nearly every major city. The illusion of permanent growth is giving way to a quieter truth. Affordability has reached its breaking point. This structural imbalance has made the system dangerously fragile. A small shock, whether from higher rates, job losses, or policy changes, could set off a chain reaction. With so much household wealth tied to property, even a moderate correction could ripple through the entire economy. Britain's housing dream is becoming its biggest liability, and the cracks are already visible beneath the polished bricks. The time bomb isn't just ticking, it's echoing through every mortgage, every rent payment, and every unsold house that still carries yesterday's price tag. Number 2. Rising interest rates. The silent engine that once powered Britain's housing boom has now reversed direction. For over a decade, ultra-low interest rates made borrowing effortless, luring millions into mortgages that seemed manageable. But as the Bank of England tightened policy to control inflation, that comfort turned into pressure. Payments that once fit easily into household budgets are now stretching families to the limit. A borrower who paid £900 a month in 2021 might now face nearly £1,800, draining savings and forcing lifestyle sacrifices. What once felt like ownership now feels like survival. The impact doesn't end with homeowners. Rising rates cool the entire property chain. Buyers hesitate, sellers lower expectations, and investors back away. Construction firms stall projects, fearing they won't find takers at current prices. Mortgage approvals have plunged, creating a freeze in transaction volumes unseen since the financial crisis. The housing market thrives on motion, but right now it's frozen between fear and uncertainty. The longer these rates stay high, the more cracks widen. Refinancing becomes unbearable, repossessions rise, and property values begin to soften under the weight of debt. Confidence, once the backbone of British real estate, has turned fragile. Every additional quarter-point hike pulls another thread from the fabric holding the market together. The new reality is simple yet brutal. Money is no longer cheap, and the entire system built on that illusion is being forced to face its true cost. Number 3. The mortgage expiry cliff. A quiet countdown is already underway across Britain's suburbs. Nearly 1.5 million households are about to exit their low fixed-rate mortgage deals within the next 12 months. For many, this will mean moving from comfortable 2% rates to painful 6% or higher. The difference is life-changing. Families who planned holidays and savings will now face tough choices between higher payments and daily necessities. The reality is that these deals were signed during an era of artificial stability, and that era has abruptly ended. Each expiring contract now acts like a small detonation in a larger economic minefield. The emotional toll is mounting as lenders send out renewal letters with figures that seem impossible. Refinancing becomes a moment of panic, not relief. Those unable to afford the jump are already exploring forced sales or renting back their own homes. Banks, aware of the risk, are tightening credit standards, pushing even more buyers out. The pipeline of demand, once steady, is drying up faster than expected. Every renewal becomes another shockwave rippling through the market. This wave of expiries threatens to reshape the housing landscape. As payments surge, consumer spending contracts, and neighborhoods that once felt secure begin to feel the squeeze. The so-called mortgage expiry cliff isn't a distant warning, it's the most immediate danger to stability. Without intervention or rapid income growth, thousands could slip into arrears, dragging prices lower and confidence with them. Each month that passes brings the market closer to its point of no return, where affordability collapses and the time bomb's next fuse ignites.
Number 4. Stagnant wages versus inflation. The gap between income and living costs has widened into a canyon. Over the past decade, house prices have surged nearly 70%, while average wages have barely moved. This imbalance has made homeownership feel like a luxury, not a milestone. Even as inflation begins to cool on paper, the damage remains. Groceries, fuel, and energy bills still weigh heavily on families, consuming what little disposable income is left. The average worker now spends a greater share of their earnings just to survive, leaving almost nothing to save for a deposit or to manage rising mortgage payments. This stagnation has frozen ambition. Young professionals who once dreamed of buying are now locked into renting cycles that drained their savings. Meanwhile, those who bought at the peak are discovering that income growth has not kept pace with debt growth. Every small increase in costs, from council tax to heating, erodes the fragile balance that keeps homeowners afloat. What once looked like a safe investment now feels like a financial trap built on flat pay and inflated prices. When wages stall but inflation persists, the foundation of the entire market begins to crumble. Without stronger real earnings, demand cannot recover and prices cannot remain propped up forever. The system now relies on hope rather than fundamentals. The British worker's paycheck has lost its power, and with it the illusion that property ownership guarantees security. The housing market can only stretch so far before reality forces a correction, and that reality is getting closer with every stagnant payslip and every overextended family budget.
Number 5. Collapse of the buy-to-let market. For years, buy-to-let investing was Britain's quiet gold rush. Landlords borrowed cheaply, filled properties fast, and watched values rise. That era has ended. A combination of higher mortgage rates, heavier taxes, and strict regulations has crushed profitability. Many landlords are now paying more in interest than they earn in rent. The financial logic that once made rental property a secure investment has flipped upside down, forcing owners to sell or face mounting losses. The market's former heroes, private landlords, are now exiting in record numbers, and each departure removes another pillar of housing stability. This exodus is squeezing tenants as well. With fewer rental properties available, rents are climbing to record highs, pushing more people toward overcrowded homes or long waiting lists. The imbalance has created a cruel paradox. Owning is unaffordable and renting is unbearable. First-time buyers who once relied on the rental sector to save now find themselves spending everything just to stay housed. The cycle feeds itself, trapping millions in financial limbo with no way forward. The ripple effects stretch far beyond landlords and tenants. A declining buy-to-let sector weakens the entire housing economy, reducing liquidity, lowering transaction volumes, and amplifying volatility. Small investors who once stabilized local markets are gone, replaced by corporate buyers and foreign funds. When the middle of the market collapses, the system becomes top-heavy, vulnerable to sharp swings. What began as a tax adjustment has evolved into a structural fracture, reshaping the property landscape for years to come.
The once celebrated buy-to-let boom is now one of the clearest warning signs that Britain's housing time bomb is getting closer to detonation.
Number 6. Construction slowdown. The cranes that once defined Britain's skyline are now standing still. Rising material costs, higher borrowing rates, and ongoing labour shortages have brought new housing projects to a near halt. Developers are shelving plans, unable to secure financing or confident buyers. The result is a construction freeze that chokes future supply while disguising the market's deeper weakness. Every delayed foundation and cancelled project represents a lost home, a lost job, and another sign that the system built on perpetual growth is beginning to stall. This slowdown is reshaping cities and towns alike. Builders, facing tighter margins, are prioritizing luxury developments over affordable homes, worsening inequality. Smaller construction firms are collapsing under debt, leaving unfinished projects scattered across the country. The government's housing targets, once ambitious, are now quietly fading into the background. With fewer homes entering the market, supply shortages continue to mask falling demand, creating an illusion of stability. But beneath that surface, pressure is mounting. The long-term damage could be profound. Without steady new builds, the next generation faces even fewer paths to ownership, and housing affordability will remain a distant dream. The slowdown also weakens local economies dependent on construction, from suppliers to tradesmen. A market that can't build for its future is a market already losing its foundation. What began as a financial adjustment is now a physical one. Empty plots where progress should have stood, silent machinery where hope once hummed. The slowdown isn't just economic, it's symbolic of a nation running out of space to grow. Number 7. Foreign investment decline. For decades, foreign capital treated the UK, especially London, as a safe haven. Wealth from Asia, the Middle East, and Europe flowed freely into high-end property, keeping demand strong and prices inflated. But that tide is receding. A weaker pound, higher taxes on overseas buyers, and rising global interest rates have made Britain far less attractive. Investors who once saw London as a guaranteed win are now diversifying elsewhere. The glamour of British bricks and mortar is fading, replaced by caution and retreat. This pullback has exposed just how dependent the housing market had become on external money. Prime properties that once sold instantly now sit on listings for months. The chain reaction moves downward. When luxury homes slow, the ripple hits mid-tier and first-time markets too. The illusion of endless foreign demand kept developers building high-end units no locals could afford. Now those same developments are becoming ghost towers, half-sold and quietly discounted behind closed doors. The retreat of foreign capital leaves a dangerous vacuum. Without that financial inflow, property prices lose one of their strongest supports. Yet ordinary buyers cannot fill the gap. Their wages and savings simply don't stretch far enough. This imbalance reveals how artificial the market stability really was. When the foreign tide goes out, Britain must finally face the real value of its homes, not the price global investors were willing to pay. The slowdown isn't just economic, it's psychological. A market once fueled by international prestige now stands exposed, waiting to see what happens when outside confidence no longer props it up. Number 8. Demographic pressure and aging population. The shape of Britain's housing market mirrors its people, older, wealthier, and unevenly distributed. Baby boomers hold the majority of property wealth, often sitting on homes worth hundreds of thousands of pounds, while younger generations rent indefinitely. This aging ownership base has created a lock on supply. Many older homeowners prefer to stay put, reducing the number of available homes for sale. The result is a frozen market where the same properties circulate among the same demographic, leaving new buyers priced out and frustrated.
Yet, as this generation begins to retire and downsize, the system faces a new imbalance. A flood of large family homes could soon hit the market, just as younger buyers lack the income or credit to purchase them. That mismatch between supply and demand could trigger localized price drops, especially in suburban and rural areas where retirees dominate. Meanwhile, city centers remain overcrowded, with renters competing for smaller flats, widening the divide between age groups and regions. This demographic shift isn't just economic, it's cultural. Property once symbolized progress across generations, now it marks division. The next decade will determine whether property wealth can transition smoothly or collapse under its own weight. As ownership ages, so does the system built upon it, leaving Britain with a stark choice: reform policies to empower younger buyers or face a market slowly draining vitality with every passing year. The ticking of this time bomb isn't only financial, it's generational, echoing through homes that may outlive the dreams of those who built them.
Number 9. Government policy failures. For decades, housing policy in Britain has been guided more by politics than by planning. Successive governments promised affordability, yet delivered short-term schemes like Help to Buy that inflated prices instead of stabilizing them. By subsidizing demand without fixing supply, these programs poured fuel on an already overheated market. Planning laws remain outdated, tangled in bureaucracy that delays construction for years. Meanwhile, genuine reform such as easing zoning rules or incentivizing affordable development has been buried under election slogans and photo opportunities. The result is a system that rewards speculation and punishes sustainability. Property investors benefit from tax loopholes, while renters face relentless increases. Local councils, once capable of building homes, have been stripped of funding, leaving private developers to dictate priorities. This imbalance has left Britain with a patchwork of overpriced flats and a shortage of family homes. Every political cycle resets promises, but the structural flaws remain untouched. The dream of a home for everyone has been replaced by the reality of a profit for someone. These failures compound every other weakness in the market. Rising interest rates, stagnant wages, and construction slowdowns might be manageable with a coherent strategy, but none exists. The absence of long-term vision has turned housing from an asset into a liability. Until policies prioritize stability over quick wins, the market will continue to teeter between inflation and collapse. Each missed reform adds another tick to the housing time bomb, counting down in the silence of broken promises and unaffordable dreams.
Number 10. The debt overhang. Beneath Britain's housing market lies a mountain of debt so large it defines the entire economy. Household borrowing now exceeds £1.8 trillion, with mortgages forming the bulk of it. For years, cheap credit made that load feel light, but rising interest rates have transformed it into a crushing weight. Families who once saw property as a path to freedom now see it as a chain. Every rate hike tightens it further. The illusion of wealth built on borrowed money is fading fast, exposing how fragile the foundation truly was. This debt burden doesn't just affect individual homeowners, it slows the entire nation's pulse. When more income goes toward repayments, consumer spending collapses, businesses shrink, and tax revenues fall. The government, already stretched by record deficits, has little room to intervene. Even a mild downturn could push thousands into arrears, forcing banks to absorb losses and tighten credit further. The cycle feeds itself. Less spending leads to slower growth. Slower growth leads to more job insecurity, and job insecurity triggers more defaults. The UK's prosperity has been tied to rising property values for too long, creating a dangerous dependency. Now that the tide of easy money has turned, the risk of collapse grows sharper each month. The debt overhang is the fuse connecting every weakness in the housing system: overpricing, stagnation, and policy failure. When that fuse burns through, the explosion won't just shake property owners, it will reverberate across the entire economy, testing Britain's resilience in ways not seen since the financial crisis. The signs are no longer subtle. The UK housing market stands at a crossroads where illusion meets reality. Prices inflated by decades of speculation now rest on shaky ground, strained by rising interest rates, stagnant wages, and unsustainable debt. Each factor feeds the next, creating a slow-motion crisis that's no longer theoretical but visible in repossessions, empty listings, and fading buyer confidence. The dream of homeownership that once defined Britain has become a test of endurance, where survival matters more than success. Yet awareness is power. Understanding these 10 warning signals means seeing the storm before it hits. Britain doesn't need panic, it needs planning, reform, and realism. Whether you're a renter, buyer, or investor, the moment to think critically is now. Don't rely on headlines or hollow optimism. Study the data, protect your savings, and prepare for volatility that could reshape the nation's wealth for a generation. If this breakdown gave you clarity, hit like, share it with others, and subscribe for more deep dive analyses into the forces shaping our financial future. Comment below, how close do you think the housing time bomb really is? Let's start the discussion before the detonation begins.